Hi folks, welcome to the Weekend Investing Daily Bite of 23rd of May. Today is Friday, so we are going to do the Ask Weekend Investing round. But if we talk about the markets first, do read the disclaimer and do subscribe to the channel. The markets essentially defying any continuity of trend. So last four sessions, we've gone down, then up, then down and up. We're really not net going anywhere. And if we see the last nine sessions, we are still where we were nine sessions back, which is not a bad thing actually. So, given that we've had some FI selling once again, despite that the market is holding up pretty nicely. There's a lot of scare about global yields going up. That scare is also getting taken into stride. I think about 90% or more companies have already delivered their results. The profits that have come through is not beyond what is expected, probably slightly less. So there is really a lot of reasons that market could go down, but it is not going down. So that is the key, that the markets is sustaining where they are, and which we have no complaint if the market is sustaining higher. So 1% up on Nifty today, and this comes on the back of 5,000 crores of selling yesterday by FIs. Yet some decent results, I think, by ITC and few others fueling the rally up. In the Nifty Junior space, also 0.57% up. So the last three sessions trying to make up for this loss that we had on Tuesday. Net, no real loss for the week gone by. In the mid cap space, also some climb back at 0.59%. And in the small cap space, again 0.59%. So nothing really has gone bad this week. In fact, we are making small and surer steps towards higher ground. Bank Nifty making a good move today at 0.83%, and we are again near the top of this flag, and potential of going up, much higher up is opening up gradually. 0.8% on Nifty Bank. Gold is absolutely flat. It is also at a crucial trend line here, the imaginary trend line that you can see. And once that, if it does break out, could easily go towards 100,000 or 110,000 for the Indian rupee per gram, per 10 grams. Advanced decline, absolutely flat. You can see here that morning in the first few minutes, it reached the same level where it remained the entire day. There was a dip during the forenoon, but pretty much intact. So that tells you that the top 500 stocks were reasonably stable during the day. 331 advances to 168 declines. And reasonably green is what you see on the Nifty heat map. Um, ITC, as I mentioned, 2.3% up. Eternal, Adani Enterprise up. You had some uh, IT companies up, banks were up, some banking finance was up, Reliance was up. And in the Nifty Next 50 space, you had some profit booking in HAL, in Torrent Pharma, Jindal Steel, Siemens, some gains coming through in Bajaj Holding. Swiggy was up, BPCL was up, Naukri was up, VBL was up. So sporadic gains coming in different sectors. If we see the sectoral trend, then capital market did the best at 2%. So BSC Limited, still not yet clear where that expiry debate will go between NSE and BSE. SEBI is yet to come out with that report, and that is going to impact the Nifty capital market via BSC Limited. BSC, however, went through a X bonus event today, so two new shares of BSC Limited will be given for each BSC held earlier. And the other sectors that did well today were FMCG and consumption. So this is basically one day we get some poor results of FMCG, and FMCG was thrashed 2 days back. And yesterday, after ITC's result, I think the FMCG confidence and consumption confidence has come back. Private banking space also moving up 1%. Financial services also moving up nearly 1%. IT stocks also moving up 0.95%. If we see the weekly change this week, capital markets, PSU banks, real estate, and defense. These are the four sectors that really made some positive gains. And IT, oil and gas, commodities, autos, tourism, and pharma. These were the ones that lost some ground along with FMCG the last 1 week. Sector of the day remains capital market. You can see it has come back up very nicely from 3,000 levels, the index, to nearly 4,200. And Angel One was leading the charge today, 5.78% there. BSC 360, KFIN, and Anand Rathi were few other stocks that were going up. So uh, we'll start the Ask Weekend Investing round, 43. Um, I would like to again request you, please do try to uh, give a thumbs up or like the channel and subscribe to the channel if you haven't. That really makes a lot of difference to not just our motivation to keep doing this on a day-to-day basis, but also it helps the YouTube algorithm to discover us and to propagate us on the YouTube. So please do that small help if you can. Um, in this round of questions, basically we take up 10 to 12 questions every week. We've done 720 queries before. All those videos are available if you want to go through them and listen to my opinion about many things. I could be right or wrong about things. I give no guarantees that whatever I'm saying has to be, gospel truth. I'm also learning as I go through the situations from day to day, and I try to give my best responses as much as possible. But then you have to take that with a grain of salt as well. Mr. Joshi says, is momentum an example of how to not let confirmation bias play a role in investing? Not just momentum, but any non-discretionary way in which you can structure your investing, where your biases can be removed to a large extent. I think that is an example of not allowing your confirmation bias play through. Momentum certainly is an example of that. But even if you were not doing momentum, anything else which is very structured, where the decisions are very objective, can potentially lead to avoiding any confirmation bias. But momentum is a fantastic example. There is no doubt about it, and uh, we've seen it over the last decade how uh, you know despite a lot of narrative about lot of sectors, lot of stocks, unless those stocks are presented to you in terms of their entries or their exits, you really don't act upon them, and that's the beauty of having a structured non-discretionary approach. Mr. Grover says, what is one biggest problem of mutual funds small cases solve? Okay, so there could be several actually. The one biggest problem I would think is the transparency of what you're holding at any point of time. Uh, Mutual funds may give you a disclosure at the end of 1 month or 3 months as to what they're holding. Here you have complete transparency of what you're holding and a complete control over an instantaneous decision. So let's say at 10 a.m. today, if you feel like that, I don't want to be in the market, you can immediately liquidate your small case. Whereas in the other case, you may get tomorrow's NAV, and by that time, some damage perhaps can happen. Um, the third thing, and I'm not saying this only because we are running small cases. In general, I would say for people, and I'm not even advocating that small cases are necessarily better than mutual funds for everybody. There are people who like to not be involved, right? Just take my money and if I get a reasonable return, I'm fine with that. That is one kind of folks. There are other people who want to be involved, who want to know what is happening, who want to have their uh, part in that activity that is happening, and small cases solves for that also. The fourth thing that I would feel is important is to know the small case manager almost on a at a reachable length, where the manager is answering your questions, or at least he's approachable. In a mutual fund, I'll be talking to a customer support, and I will never be talking to the fund manager. I will never really understand what is their philosophy. Yes, they will give some broad guidelines in some larger meets, perhaps some of them do that. But in other cases, you will not even know who's the fund manager. A lot of folks don't know who their fund manager is and how frequently are those changing. So let's say I have put my money with certain AMC and the fund manager changes, I perhaps will not even come to know. So how one fund manager perceives the market and how his replacement is going to do, we don't know really. So it is a matter of very individual perception basis which small cases are getting run. So I think these are some of the issues which are different from mutual funds. Uh, and I would like to imagine that over a longer period of time, well run small cases are going to do better than well run mutual funds. And that is sort of the one additional thing that I would think would work. Uh, as I said earlier, there is no one glove which will fit everybody. So, depending upon what is that you feel is a problem with either of them, and if the other one is solving it, then you can go for that. That's my sort of take on it. Question from Kapil says, got funds from PPF maturity. I am 46, looking for investment which is relatively safer. Please advise the suitable investment avenue to invest. So I can tell you, Kapil, that I really cannot give you one-on-one advice. That's not a part of my license mandate. But in general, I can always say that try to distribute your corpus amongst different asset classes, amongst different parts of the market. So, investing in large caps versus mid caps versus small caps or all. Uh, and I don't know what is the corpus, so it could even be if it is large enough, you could go into real estate, you could go into gold, uh, and you probably need a financial advisor for this advice. So I'm probably not the right person to say much on this, but certainly go gradual in the market over a spread it out over a period of time, and have a long term view, and you'll do wonderfully well. I have no doubt about that. Next question is from Suyash. How much alpha should small case generate over, say, an equivalent mutual fund to be able to compensate for costs and charges? Okay, good question. Let's assume, for argument's sake, an equivalent mutual fund generates 12% return. It could be any percentage, the percentage will not matter. So let's say you hold it for 5 years. Now, at the end of 5 years, you will sell that mutual fund, and let's say you got 12% CAGR, and you'll pay long-term capital gains tax on that. So you'll probably pay like 12%, I think, is the this thing. So net you will get about 10 point X percent CAGR post the cost, and of course the cost of whatever mutual funds are charging is already built in. So 10.5%, let's say 10.56% is what you get post tax. Now, to compensate for the short term nature of your small case trades, let's assume 100% of your trades on small case are short term in nature. And I'm assuming 100% just to give complete benefit of doubt. It could be lower, it is actually lower, but let's say 100%. All stocks that you buy will be applicable for short term capital gain. And let's say small case makes you 15% return. I'm not even talking very big numbers, talking, let's say, 15% return. And let's say the dividends that you get on that, because the small case returns are not inclusive of dividends, take care of perhaps, let's say, the transaction cost. And you are putting in enough money to make sure, let's say, your subscription cost is less than 1%. Assume worst case scenario, let's say 1% of that, right? So now on 15%, you would have to pay 20% capital gains tax. So let's say you get post tax 12% return, right? 15 minus 3 is 12%. And assuming 1% is your cost of subscription, that will take away another 1%. So you are somewhere near 11. So versus 12 of mutual funds, where you got post tax 10.6, and if you got 15 in small case, where you ended up with 11, they are somewhere near equivalent. So maybe like 12 and 14.5% in small case. So 2.5% on this base is where the equivalent alpha should be. In my view, for many small cases which are geared towards more higher alpha, that number will be much more than 2 to 2.5%. If they are geared towards matching some index and replicating some index, maybe it will be close. But for many small cases, that will be a much larger number. So now you have the entire math with you. And of course, the benefits that I mentioned in the last few questions, if those appeal to you, then of course you can go for it. See everything. I want to just add here because I know a significant number of people also feel very strongly about this 2% additional tax. Uh, so this is, I mean, as I mentioned, you are assuming that the mutual fund that you buy is going to be beating the market. So you can compare the best of small cases with best of mutual funds, or average of small case with average of mutual fund. That is one. The second part is that not everything is only about returns. As I mentioned, there is a sense of control, there is a sense of transparency, there is a sense of knowing what your fund manager is doing, there is a sense of knowing the fund manager itself. So if you are chasing returns and if your small case is not generating that minimum alpha that I said, then maybe yes, small case doesn't make sense for you. But there are so many people who, I mean, especially HNIs, who don't want a 25% return. They're saying we are happy with 15%, but give me that assurance or give me that confidence that you're going to be running this basis, these themes or these systems. And I'm reasonably confident that over 1 or 2 or 3 cycles, we will, catch some strong trends and we'll make it through. So it all depends upon what is your outlook. Like if everybody wanted, the most fuel efficient car, no other model would exist except perhaps Maruti 800. So everybody wants different things, and hence, different products exist. I hope I've been able to clarify. Jatin says, how quickly or often will momentum catch sectoral shifts in the market? Can momentum identify the difference between fluff and real sectoral shifts? A lot depends upon the design of the momentum strategy. Momentum ETFs, for example, some of them will rebalance in 6 months. Some of our momentum strategies may rebalance in a week. Now you can determine whether who will be able to catch sectoral shifts faster. Whether we will get trapped by false signals more, yes, perhaps, because we are frequently looking at the rebalance. Whether there will be some fluff moves, that is always possible if your design of the strategy is that eliminate stocks with red flags, then perhaps fluff moves will be lesser. So all depends upon the design. I'm not saying what is good, what is bad, but yes, momentum can do all that you desire in this question if you design it that way. Preetham has the next one. Is it natural for momentum strategies to experience a slightly volatile period during falls from peak? If yes, why does that happen? So, by nature of the strategies and by nature of the market participants, as soon as a fall starts to happen, what does the very common investor do? Is to book profits where there is profit. Where there is a loss or the stock has not moved, nobody's wanting to get out of that. People want to book the at that in those stocks or sectors where they have the maximum gain. And that is why whenever there is a fall from peak, the stocks that are in momentum at that point of time are likely to fall more than others. They, of course, they were running much harder than others also, and they fall more also. Uh, so that's the first one. Isn't momentum supposed to outperform during downward trends also? So while by design, that is the intention, that in deep crisis especially, you should be able to either go to cash while the market is falling, or move into defensive stocks while the market is falling. Now, it also depends upon how the market is falling. In COVID crash, for instance, there was outperformance on the downside. But in smaller corrections like what we have seen now, that tendency has not played out because the strategies are designed to outperform in deep crisis. In smaller crisis, even if you are not able to outperform during downtrend, the upward trend when it comes, and if it outperforms, the loss is made up in that leg or so. So while the design is such that over a longer cycle, over 5 years, once you experience two or three cycles, it should make up for all kinds of underperformance during any small period. There is still no guarantees or assurance of that. It is a design of the strategy which is intended to catch the strongest players, but there is no sort of absolute potential of that happening every time. So that's the sort of like just like in any other thesis of or style of investing, nothing can be 100%. Like, I know that if I'm going to drive in the evening, I'm likely not to hit an accident. But can I guarantee that? No, I can't do that. So that's how the things are designed. Shripal says if we can make 12 to 13% compounded return in other business without almost negligible risk, then is it advisable to invest in equity? I think businesses without risk is a very difficult scenario to imagine. Almost all businesses run with huge risks, even if they may seem less risky. Even if you may feel that you're sitting in your own shop and there is sales that is happening and there is no risk to it. Tomorrow, your next door neighbor could open a better shop with better prices, and you'll be moved out of that business. So business exists with risk, and if it is negligible risk, then you are getting sort of negligible returns. I mean, if you have to do business where you're going to spend time, you're going to take some risk, and if you're going to make 12%, then I'm not sure how much worth it is to have that business unless it is extremely largely scalable, and you can still keep that risk very low. So while I'm also shooting in the dark what kind of business you're talking about, I'm certainly not a business consultant. But that is one part of it. And then the other part is that if you're comparing it with the business, then you have to compare a lot of things. How much time are you spending in it? Are you able to scale it or not? Because if you're going to compare it to equity, and let's say you have some manager you're going to give your money to, some PMS, AIF, mutual fund, small case, whatever, wherever is your money getting deployed, how much time is it going to take of you? Hardly anything. It is quite scalable, right? I don't know how much that business is scalable or not, and that too with negligible risk. So it depends upon a lot of these factors. But for diversification itself, let's say you have this business and you're running it at good scale. Just for diversification, it would be advisable to invest in equity. So I hope I have been able to give some uh, color to this discussion. Naveen has the next question. Are EGRs, the electronic gold receipts, traded? What are pros and cons of EGR versus gold ETF versus physical gold? Are there vault providers for retail customers who accumulate physical gold? So I'm not aware of EGR trading. They were supposed to start trading. Whether they are trading or not, or whether they are trading in volumes, I'm not aware of this. I'll try to find that out. ETFs are a very established um, form of digital or electronic form of buying and selling of gold, and the physical gold backing it is kept at custodians. So gold ETFs are certainly uh, there's a lot of pros in it. The only con is that the gold is not in your control hands, and you have to depend on the ETF provider for its pricing. And of course, they will take 0.5%, 1% of cost per year on that. Physical gold, of course, is the most pristine format of gold. Um, Gold is a very special commodity with monetary ramifications only because it has no counterparty risk. If you hold your gold, you are the owner of that gold. And that's why all central banks want to bring gold to their own jurisdictions and have it under their control. If your physical gold is lying with somebody else, then, unless that somebody else returns it to you, it's not really yours. So vault providers, again, similar issue is there, that they could be private vault providers. Globally, this is a very common phenomena. In India, there are private vault providers, but very few people have trust. Because what if, tomorrow you go to your vault and the entire vault is empty? Uh, so those kind of issues are there. Um, People have more trust in banking system vaults, so authorized banks having vaults, although there is no uh, cover by the bank on those vaults or lockers as they are commonly called. So if you keep your gold in the locker and tomorrow if you find that your locker has been emptied out, I don't think there is any cover on that beyond certain few lakh rupees. So there is potential risk there as well. What if somebody, breaks into the bank lockers, cleans out 10 lockers? How will you prove ever that, what you had kept there, because there is no record? And even if you had record and, you could show purchase slips, it will be very difficult to prove that, you had put that gold there. So all those issues are there. But yeah, I mean, out of all this, if you really wanted no nonsense kind of a thing, then gold ETF probably is the way to go. But then it has its own limitations as well. Oh, this is the end of the Ask Weekend Investing round. So thank you so much for everybody who chimed in their questions. Those I have not been able to take up, I'll take it up in the next episode. These answers are, as I mentioned earlier, these are to the best of my ability. Need not be 100% right also. So please have that disclaimer from me on those things. And do keep writing in, and do keep sending in your queries. It is good to interact on these questions. All the previous episodes are put here. They are in the description. You can go through them. There's a lot of potential learning for a lot of new folks regarding market, because a lot of different types of questions have been asked. So please go ahead and watch few more episodes of the Ask Weekend Investing Round. And of course, you must subscribe to this channel and give it a like if you like the content. That will be really, really nice. Thank you. Bye.